In 2013, a Chinese company acquired Smithfield Foods. The 2013 acquisition of Smithfield Foods for $7.1 billion by China's Shuanghui Group represents the largest Chinese takeover of an American firm in history. The move came at the behest of the Chinese government, whose 2011 five-year plan called for China to increase its food security by having both private and state-owned firms acquiring foreign food firms abroad. Smithfield, now a Chinese company, owns roughly 25% of all pork production in the United States. Now, keep in mind that China is a net food importer. China does not produce enough food to feed its people, number one. Number two, pork is the number one meat in China, and China is the number one consumer of pork. China now owns 25% of the pork production in the United States. Again, in other countries, particularly in China, food would be listed as a sensitive or restricted area. So in the U.S. and many countries, we might look at weapons or military equipment as being sensitive. But China looks at a lot of things as being sensitive, including chemicals, right down to table salt. In this case, food, farmland, and of course, all sorts of electronics that could be used for telecommunications, military communications, things like that. They're all considered sensitive in China, but in the United States, most of these sectors are pretty much wide open. Anybody can invest in them, including the Chinese government. Before announcing their last five-year plan, or the 2011 five-year plan, China owned just $81 million of U.S. farmland. By 2012, that number had jumped to $900 million and currently stands at $1.4 billion. China owns $1.4 billion worth of U.S. farmland. With the Smithfield acquisition, Shuanghui has now become the world's largest producer of packaged meats, fulfilling another of Xi Jinping's edicts to create global champions. So this concept of global champions is that Xi Jinping had a vision that he wanted to have X number of global champions, and they actually set a schedule. By this year we want to have X number of global champions. By next year we want to have so many. By 2025 we want to have so many. And one of the areas that they want to have global champions is in food production. So basically what they want to do is they want to dominate various sectors of the world's economy, global economy. So they want to have the largest bank in the world, and now they have that. They want to have the largest food producer in the world, and now they have that. They want to have the largest whatever it is producer, and they will have that. And these are all government plans, government programs. They're either in the five-year plans or they're in other government edicts. They are published. This is not some secret cabal that I have insider information, something I heard from a confidential informant. I mean, this is published. These are published programs. When they're published, then they go on the radio, they go on TV, go on social media. There's big, what they call large character posters around China telling people about the new plans and the new, by 2025, we're going to have the world's, 150 largest companies or whatever the plan is. And these plans are published, and these companies are fulfilling these plans. These companies are investing in the United States. They are using U.S. pension fund monies. They are using U.S. bank monies. They're using basically the money of U.S. taxpayers to fulfill the plans, programs, and edicts of the Communist Party of China. Although Shuanghui is not state-owned, in its company brochure, it recognizes its duty to adhere to Beijing's five-year plans. It says that right in the brochure of the company, it recognizes its duty to adhere to Beijing's five-year plans. In that document, it was clear that Shuanghui meets its obligations and follows the path laid out by the Communist Party. Despite its public listing on Hong Kong Exchange, Shuanghui answers to the Chinese government. Going beyond regulatory compliance, it receives directives from Beijing, and it follows them. In exchange for helping to further the economic plans of the Communist Party, companies can benefit from soft loans granted by state banks. For example, Shuanghui received a $4 billion loan for the Smithfield takeover, a loan which was approved in a single day. According to the Bank of China's 2013 annual report, granting the loan was part of the bank's social responsibility in carrying out the government's plan to have Chinese companies expand by buying up their overseas competition. In addition to loans, Chinese government has granted Shanhui $2 billion in subsidies. So you have Chinese government gave subsidies and soft loans to a privately owned company, nominally privately owned company, which then bought 25% of the pork production of the United States. The U.S. does much less to restrict market access to Chinese firms than vice versa. Semiconductors, energy, nuclear, military hardware, and food would all be off limits for U.S. investment in China. At present, the Treasury Department, which reviews foreign acquisitions of major U.S. businesses, does not include food as part of national security. Voices in Congress are asking to have the definition expanded to protect U.S. food and farms. On top of all the soft loans and unfair subsidies Shanhui was able to obtain at home, Smithfield Foods qualified for part of the $1.2 billion in U.S. farm subsidies created in 2018. So in 2018, when the U.S. government gave subsidies to U.S. farms, this included Shanhui, because in the United States, regardless of the ownership, the country of ownership of a company, if the company is headquartered in the United States, it's treated as a U.S. company. So the U.S. government gave subsidies to this company, which also receives subsidies from the Communist Party of China. China needs U.S. money. In the 15th five-year plan, Xi Jinping called for innovation and development in technology. Technology is a type of business which requires a lot of cash and which may or may not turn a profit. So you need a lot of money for research and development if you're going to be in the technology sector. And the best place to find cash investment for Chinese technology is in the United States. In 2013, 101 new Chinese companies listed on U.S. exchanges, raising a total of $46.1 billion, which makes China number 2 behind U.S. companies at raising money from U.S. listings. In 2019, Chinese companies accounted for 55% of all foreign listings, raising more than $118 billion. In the past 5 years, the largest of the Chinese IPOs was Alibaba Group, which raised $25 billion. President Trump has talked about delisting Chinese companies. If President Trump moved to delist Chinese companies from U.S. exchanges, on the one hand, this would be somewhat damaging for the U.S. economy, as these IPOs would move to Shanghai or Hong Kong. On the other hand, as the U.S. has the deepest capital markets, this would most likely hamstring China's ability to bring new technology firms to market and ultimately to raise money for research and development. Much of the money that funds China's technology startups comes from venture capital firms who manage money for public retirements. And these are U.S. firms, U.S. Venture capital firms managing U.S. public retirements. That could be the teachers' retirement fund, firefighters, police, and so on. Venture capital firms seek out likely companies to invest in, creating a portfolio of various stakes in multiple companies. As technology is an area of fast growth and high upside potential, they wind up investing in such companies as Chinese drone maker DJI and artificial intelligence pioneer SenseTime Group. Delaware Public Employees Retirement System and State Michigan Retirement System were both significant investors responsible for DJI's growth into the world's leading drone maker. So using public retirement money from the United States, a Chinese company became the leader in their industry, which happened to be drone making. And this year, the U.S. Department of Homeland Security has warned about investing in Chinese drones for national security reasons, but it is unclear if any bans have been put in place. So U.S. Department of Homeland Security is saying that we shouldn't invest in drones, but in the United States, one agency saying don't do something doesn't prevent us from doing it, right? That doesn't mean that a new law was made or that a ban was made. Of course, in China, had it been the other way around, China would have prevented its companies or its retirement funds from investing in U.S. military hardware. Chinese artificial intelligence firm SenseTime received funding from the California Public Employees Retirement System and Washington State Investment Board and Teacher Retirement System of Texas. Right? And now we know that these AI systems are being used in China for surveillance, for the social credit score. They're being used in Xinjiang. SenseTime, along with MEGV and Yitu, have all been blacklisted by the Trump administration due to implications of human rights violations and their use in repressing the Uyghur in Xinjiang. This means these three firms are banned from doing business in the United States, prohibiting them from purchasing U.S. products or maintaining relationships with American entities, but they have been invested in by American public retirement funds. So ByteDance Limited, a leading developer of AI apps, has benefited from funds raised through the New York State Teachers Retirement System, Oregon Public Employees Retirement System, and the Minnesota Board of Investment. Now, ByteDance has not been blacklisted by the United States, but several companies that they do business with and have connections with have been blacklisted.